I'm Rob Keeney. I'm a licensed mortgage loan originator, and that means I help you buy homes and achieve wealth through real estate. So today I posted a video really talking about situations where some folks may want to consider a cash out refinance to pay off higher interest rate debts under a debt consolidation. I was asked for a little more clarification on what is a cash out refinance, and then how would a cash out refinance benefit a borrower in today's environment of high interest rates on mortgages. First of all, what a cash out refinance is when you own a home and you have a mortgage on it. Not only refinance your mortgage, but you take out some additional cash against your equity. So let's just use some simple numbers. For example, your home is worth $500,000 and you owe $200,000 on your current mortgage. That means you have $300,000 in equity. And there's a lot of folks out there with a lot of credit card debt. I literally closed a loan today for a customer, and we paid off, she had 23 credit cards. It was about $100,000 of credit card debt. And credit cards have those interest rates of 19 to 25 to 30% interest. They were suffering. So not only was I able to, get them out of that pinch, ultimately their total monthly expenses after the refinance went down by almost $1,200. And then just think of the simplification of having to pay 23 bills a month now to reduce all the way down to one. Of course, the key for them now is to not charge those credit cards back up. And we've had some pretty extensive conversations on that, and they're very committed to not doing so. They're kind of an extreme example, but when you're in a situation where you're feeling a little overwhelmed, or you need some cash, or maybe it's not necessarily to pay off higher interest rate credit cards. Maybe you have an investment you need to make. Maybe you need to start a business. Maybe you need money to put your kids through college. Who knows? Life throws different curveballs at all of us. So the cash out refinance, going back to my example, is when somebody has a home. I'm just going to use an example value of $500,000. They only owe $200,000 on their current mortgage. So they have $300,000 in equity, which is a non-liquid asset. And so the question is, how can they access some of that equity that they've got? And the cash out refinance is an answer to that. Now, in the state of Texas, where I'm at, Texas has some very conservative laws designed to protect consumers. So they limit the amount that you can borrow against your equity, with the loan amount being capped at 80% of the value of the home. So again, let's go back to my example. If the value of the home was $500,000, 80% of that is $400,000. So the most somebody could borrow in that scenario on a cash out refinance would be up to $400,000. So then in that scenario, you would get the 400, you'd pay off the existing mortgage at 200, then you'd have $200,000 left over. Again, that's to do whatever you want with, really. It could be debt consolidation. The question about today's interest rate environment for mortgage interest rates, yeah, it's kind of funny, in some regard, because yes, interest rates are up, relative to what they were 2 years ago. I'm 100% on board. They're up a lot. But really, if you look at the historical averages of mortgage interest rates, they're up a little bit, but they're not that high. In fact, I remember, I don't think I'm that old, but I remember my first home I bought 22 years ago. My interest rate was 7%. And that's about where they are today, actually a little bit less. What's comical, though, is, I don't say comical, but ironic, I think, is that people scoff about why would they refinance and get a 7% interest rate. Let's just assuming their current mortgage of $200,000 is at 3.5%. So why would they refinance and get a new mortgage at 7% or 6.5%? In today's rate. But at the same time, they're perfectly okay paying 19% on their credit cards. So it's just kind of when you think about it, a lot of those credit cards, they're not set up to where you're going to be paid off within 2-3 years. I saw one I looked at the other day, the number of payments, the minimum monthly payment, the way it was set up, it was going to take over 30 years to pay off that credit card with the interest rate that was on it and the minimum monthly payment. And the only people that benefit in that is the credit card companies. They're taking you for the ride and making as much money as they possibly can off of you. And so This really doesn't make a lot of sense to do that. A lot of good reasons this might help. If you don't feel you need the access to your equity, then by all means keep your 3.5% rate. That's the smart thing to do. But if you're in a situation where you feel you need it, or it would really help you a lot, you're feeling a little overwhelmed just from a management standpoint of monthly expenses, consolidation can help in a lot of ways. It's interesting to note that, not only for my customer that I mentioned that I closed earlier today, who is, we paid off 23 credit card bills. Not only does it, reduce her monthly expenses and reduce, or just, simplify her financial management, but also this thing, what it's going to do for her credit score. Because she had good credit. Paying all those cards off is going to shoot her score up. I'm going to guess at least 50 to 75 points. And they will have extremely strong credit. So there's all sorts of benefits for that. But, another question I got then was, who is best served by a cash out refinance? And I think it's going to be the person that they need access to their equity. But, if that's somebody that's, needing assistance in paying the bills, or they just need to get some bills paid off, they're starting a business. Maybe they're wanting to tap into the equity on their home so that they can buy an investment property. Then you can use that money for a down payment on another home. Those are the type of people that are best served. Who would be least served? It's going to be people who, one, don't really need the money, that they access to their equity, or if they only have a little bit of credit card debt. It's going to be best served for the person who has a lot of credit card debt, if that's the goal. If somebody's looking at considering this just because, they're paying 19% on their credit cards, but they only owe a couple $1,000s on credit cards, and no, it doesn't make sense to refinance an entire mortgage for that. I think it has to be somebody that's got some substantial, debt to pay off that's, at the higher interest rate. But somebody with a low amount, it doesn't necessarily make sense unless it's just the access to the equity, starting a business, kids in school. Who knows? We all have our situations in life. Another question I got was, how does the cash out refinance differ from a regular refinance? And, the regular refinance we call a rate and term refinance, meaning we're not taking any cash out. We're just going to, keeping in line with my example, if it was a, $200,000 mortgage on the current mortgage, we're going to refinance just the $200,000. Now, normally you only do that when you're going to get a lower interest rate. So in today's environment, there's not a lot of people that are going to get a lower interest rate with a 6.5. Now, rates are expected to go down in the next 6 to 12 months as inflation finally is starting to come down. 6 to 12 months, if rates are down to about 5.0, then there's going to be a lot of folks who have bought homes in this last year and a half that are paying 6.5%, 7.5% interest. That will benefit greatly. And I'm always glad to show people. I'm always glad to do an initial consultation and show people how much money they will save by refinancing. Because there are closing costs, and things. So it's definitely more common to do a regular or a rate and term refinance when the current rates are lower than what you have on your current mortgage. It's called a rate and term just because that's really all you're doing. You're changing the rate and the term. So the mortgage started out at 30 years and 360 months, and you paid off 48 months of it. Well, generally when you refinance, you're taking a new 30-year mortgage, and so that helps lower your payment in two ways. So you get the lower interest rate, but then also, that balance is being now spread over, another 360 months instead of that little, 360 minus 48, 312 months. That's a rate and term refinance, where the cash out, really is this accessing your equity that you have, for whatever need that you have. And the rate and term or regular refinance, those are generally at the same interest rates as as if you were purchasing a home. A cash out refinance does have a little bit higher rate than the normal rate, and so that's another difference. Again, it all just comes down to what the motivations are, and like I said in my video earlier today, they're not for everybody. Absolutely not. And I'm here to help folks dive into their situation and see what's going to be best for them. For some people, like my customer today, by all means, cash out refinance is the way to go. Another question was, how much money can I borrow through a cash out refinance? I think there's other states like Texas, but I have done loans in other states that were above 80%. Texas, as I mentioned earlier, Texas will cap your loan amount in a cash out refinance. They will cap the new loan amount to 80% of the home's value. So again, staying in line with my example from earlier, if the value of the home is 500,000, the cash out refinance mortgage can be up to 400,000. That's 80%. Then you pay off the existing mortgage and you take cash or whatever's left. States, say some other states that don't have the laws that Texas has, generally on a mortgage, you can go up to 95% loan to value. 95% of 500,000 would be $475,000. Now, keep in mind, when your equity position becomes less than 20%, you're going to pick up mortgage insurance again. So that's going to be a kind of a little double-edged sword. You're getting some more money because you can borrow more, but when you have less than 20% equity, or the loan amounts, or the loan is more than 80% of the value of the home, you're going to have to pay for mortgage insurance too. And so that's definitely something to think about, but it can be done. The next question I got was, what are the eligibility requirements for cash out refinance? A good question. A couple things. First of all, I will say is that, again, I'm in Texas, so I'm going to talk primarily about Texas, and I know it's different in other states. So depending on what state you're in, if you're not in Texas, just ask me, and we'll find out, or we'll let you know what the situation is for your state. But in Texas, on the government-backed loans, and those are your FHA loans, your VA loans, and USDA loans, those cannot be used on a cash-out refinance. So if you have one of those loans, and you want to get cash out of your equity, then you'll have to refinance into a conventional loan. Okay, and there's pros and cons to the government-backed loans and to the conventional loans. Conventional loans can be a little more challenging to qualify for than, say, a VA loan or an FHA loan. But generally speaking, they're going to save you more money in the long run. It just kind of depends, on what state you're in. But if you need the cash in Texas, then you'll have to go through a conventional loan. Now, what are the eligibility requirements for that? It's interesting. On conventional loans, Fannie Mae and Freddie Mac, they've established a minimum credit score of 620. But, I'll be honest with you, every lender, we all run loans through their automated underwriting systems. It's really hard to get approval below a 660 or 680, and it's because it's not because they're lying about the 620. The 620 is the minimum, and yeah, maybe somebody's got a 640. They check that box. They have a high enough credit score. But they're also looking at other factors, such as how long have the accounts with good history, how long have those been open? Or how many good accounts are on the credit report versus derogatory accounts. 3 derogatory accounts and 2 good ones, but the 2 good ones are only 3 months old. It doesn't, they would view that as it doesn't establish enough history to show a consistent pattern, and so, it may get declined just because of that, and not because you didn't have a 620. Generally speaking, I'd say to buy a home, you're looking at about 660. To do a cash out refinance, I'd probably say more about 680. I'm always glad to help people. I got in this business to help people, bottom line. And I had a lady not too long ago. She came to me. She needed her equity. She was a retiree. This is another good example of who could benefit. She was a retiree on a fixed income, and her finances had gotten out of hand. And I was able to refinance her, do a cash out refinance and pay off all of her other bills too, and get her down to one monthly payment that would lower total monthly expenses. Then it fit within her fixed income budget. But when she first came to me, her credit score was like 625 or 630. And to get approved for a cash out refinance, you probably need to have around a 680. That doesn't mean a 670 is not going to qualify. Just, let's just talk and look at everything. So what I did with her is I connected her with one of my credit repair partners. And I'm not a credit repair specialist, but obviously I deal with credit a lot. However, Do know some folks who are very good. I know there's a lot of really bad credit repair people out there. Bad by bad, I mean they take your money every month, but they don't really deliver much. But there are people out there that don't take anything if they don't deliver. And so anyway, I connected this lady. Was in a tight situation, fixed income, retiree, former school teacher, math teacher. I remember her well, and she. I connected her with a credit repair person. I think it was like within 90 days, just 3 months. She was a 685. We got her approved. We got her loan done. We paid off all of her other bills. And, she was so ecstatic, so relieved to have that pressure, taken off of her on a monthly basis. And so, it's a credit score, probably plan on 680. Again, let's just talk, but debt to income ratio needs to be under 50% for a conventional loan. Really, generally speaking, qualifying for any mortgage is going to come down to two primary factors. And yes, there are some other factors, but the two primary factors are your credit score, your FICO, and your debt to income ratio. If you got those two things up, if you check those two boxes, you're probably going to be okay. So the debt to income ratio, explain what that is. That is we calculate what the new mortgage payment will be, and then we add that to all of the minimum monthly payments on your other debts. So if you have a car payment that's fixed, and you have credit card that when I pulled your credit report, it says your minimum monthly payment is $40. I'm going to add up all those minimum monthly payments on all of your trade lines on your credit report and add that to the new mortgage payment, and the sum of all of those has to be less than 50% of your gross monthly income. Okay, and so that's another key point there is gross, and that's actually a little helpful is that I get to use the bigger number. Some folks, tell me they make $3,000 a month. Well, in reality is they make $5,000. They just 40% gets taken out in taxes and benefits and deductions for whatever. And they're left with 3,000. Okay, but I get in that example, I get to use the 5,000. The total of all their expenses would have to be under 50% of that gross monthly income. So those are the two key things. A credit score 680 or more is ideal, and a debt to income ratio of under 50. There's other requirements too, but those are the biggies.